Now, to our first conversation here, West Africa's economies are entering a critical phase as governments and regional blocs like ECOWAS increasingly reaffirm their commitments to deepening trade integration, enhancing infrastructure, and catalyzing industrial growth. Nigeria's president, Bola Tinubu, has emphasized that fragmented markets where intra-regional trade remains just 10% must give way to coordinated policy, shared infrastructure, and unified value chains to unlock the region's economic potential. Well, joining us to unpack all of this, we have Charlie Robertson, the time-traveling economist. Great to have you on the show.
Thank you very much, Letty. Nice to see you.
Happy to see you too. So, looking at West Africa, the economies so far. In your view, what are you seeing right now when you look at most of the macros from inflation, GDP, and currency strength? How would you say West African economies are performing so far?
I just did a presentation for a financial group operating across the region. And I think what I was emphasizing to them was how impressive the growth numbers are for a start. So if you look at the AFDB or you look at the IMF, we're talking 4, 5, 6% growth for almost all countries, with the unfortunate exception of Nigeria, still at about 3%. And Senegal sitting up there at maybe 8 to 10% on the back of the oil hydrocarbon exports for this year. So 4 to 6% growth is good. We've then got about 2 to 4% inflation in a lot of the Francophone countries. So you've got a low inflation story, good growth story. It's most of Francophone Africa is looking pretty good. And Ghana's come out pretty well from its default, helped by booming gold prices. The one country that's obviously taking a little while to get going again after years of poor policy is Nigeria. But at least the policies are good now, in that the currency is competitive and there's efforts being made to push up oil production. So I mean, the IMF and AFDB are looking for 3% growth. Maybe towards the end of this year, it's looking better than that.
So, definitely the Trump presidency has brought a lot of attention to trade, right now, and tariffs. Everyone's talking about trade, and tariffs at this point. Looking at the bloc, what concrete steps do you think, West African governments can take to, increase intra-regional trade from about 10% to 20 to 30% of GDP?
It's hard. I mean, I've talked about this with regards to the African continental free trade area, but basically commodity exporting countries never tend to see intra-regional trade more than about 15%. That's true of Latin America, and that's true of the Gulf countries as well, which have had a customs and monetary union for 30, 40 years now. And that's true for Africa, and of course it's true for ECOWAS, and even more so for the WEMU region. So those countries with a common currency as well. Still, most of them are not trading with each other. They're trading with the rest of the world because that's where your customers are. So what can you do? I mean, you minimize customs barriers, you minimize kind of trade blockages at the border. You try and ensure that it's not just about tariffs, it's often about non-tariff barriers like safety standards. People can protect their economies. They only are jollof rice can be eaten here. That foreign jollof stuff is no good. There's various kind of safety issues that can get in the way of free trade as well. But we shouldn't expect miracles from the trade side, just because commodity guys don't tend to export commodities to each other.
So do you think, to get this bloc to trade more, that's for regional trade, do you think the ECHO is that silver bullet that would help increase trade within the West Africa region?
No. I mean, we've already seen that single currency tried in the Gulf, and it hasn't made a difference in the Middle East. And we've seen it tried in the WEMU region, and it helps a bit. I mean, there's 2 or 3 countries that do trade like 40% or so with the WEMU region, but no, the single currency isn't going to be the difference. The big difference will be when we get an industrial manufacturing base, when there's products being built across the region that people want, then we're gonna see higher inter-regional trade then. That's why Europe does so much intra-regional trade. It's not the euro. It's the fact that there's so many industries across the continent and people buying off each other.
So talk to me about initiatives we've seen so far now. We have the likes of PAPS, AFCFTA, and there's also the planned Abuja Export Trading Company. Talk to me about how all of these would help enhance, real market integration for this bloc.
I think the impact is going to be very limited, and the point that I've been trying to emphasize in the last few years and in the book, Time Traveling Economist, is that you make money by exporting to the wealthiest people on the planet, and that's how China did it. They made money, and their coastal region is much richer than their inland region. If you go to America, the coastal regions are much richer than the average American wealth in the rest of the country. It's those who can easily export from the coast to the rest of the world, to those rich customers, be it America, Japan, or now China for that matter. That's where you want to be exporting to, and that's why the coastal regions, the coast countries with a coast are richer in Africa than those that are deep inland, like Niger or Mali or Congo.
All right, let's look at some of the trade routes. Now, which priority corridors? We have the Abidjan, Lagos, Mali, Burkina, Cote d'Ivoire. Which one do you think should be industrialized first to maximize value chain impact?
If governments are trying to accelerate development, then prioritizing those export bases on the coast to the rest of the world first has got to be the place to put the money. You've got to ensure that they've got regular, cheap electricity at the coast for those factories to run efficiently. Labor's, sufficient. We've got the human capital across Lagos, Abidjan, Dakar, all of these places. We've got the human capital. We don't have the cheap, reliable energy in most of those cities yet. That needs to be the priority. But once that's up and running, the human capital and the electricity, then they will create their own value chains. They will source the cheapest possible inputs to make themselves competitive. And if you go back to Adam Smith, the grandfather of economics, back in the 18th century, he said the government shouldn't be involved in infrastructure. If there's value there, the private sector will build it.
So, when you talk about, you did mention, China and how industrialized they are, at this point. It didn't start off, like that, for China and most of those Asian tigers. But, looking at the kind of support the Chinese government, gives to, businesses there and, most of the manufacturers, how do you think, the governments in West Africa can replicate that?
Well, they can't, because the underlying reason that China could take off when it did, the same reason that Hong Kong, Singapore, Taiwan, Korea all did as well, which is they had massive local savings. The bank deposits of 50, 100% of GDP. So there was too much money in their economies. And this wasn't because of the government. This was because, I argue in the book, it was to do with small family sizes. That every country that's taken off has seen family size go from 5 or 6 kids where you've got no money to put into the bank on a Friday night. So the bank's got no money to lend, except at very high interest rates. You go from that situation to the 2 kids or 3 kids that under 3, that Singapore, Hong Kong, Taiwan, and then China all did, or India's doing now. And then your bank deposits are massive. And then your interest rates are low. Then you can afford to build electricity, cheap infrastructure. Companies can borrow money to invest and build plant and start exporting. So it comes after the fertility decline, which is happening across Africa. But we're not there yet, except in North Africa, places like Morocco, where they have the industrialization story is well underway.
All right, let's bring it out to most of the countries in the region now. Let's look at Nigeria, and definitely we know the macros. Yeah, for inflation, we know we have the rebased inflation data, and we've seen a downtrend, so far in the beginning of 2025. So, what are you seeing? I know you focus a lot on most of the macros for most of these economies, and I'm sure you've been following Nigeria's inflation trajectory. What are you seeing, so far?
I think it's this year, from a market's perspective, the Nigerian inflation story is amazing. That we've had, anecdotally, we're having food price deflation in January, February, all through April. Picked up a bit in May, but there's quite a bit of evidence that the food prices have got too high 3 to 6 months ago. Global prices, we've seen the fuel adjustment now. So I think food, fuel, all the expensive stuff for the Nigerian household, like half of the spending for the month goes on food and fuel. And that's been at world prices. So they shouldn't be going up more than 2% a year. So we're still at, just over 20% on inflation, but I can see it being under 20%. Certainly by the end of this year, possibly quicker. So I think the inflation trajectory, I think we've had the worst, and it was bad. 23, 24, 25 was, 23, 24 was really hard. But I think we're on a much better trajectory now.
And definitely, when we talk about inflation on that downward trend, some would say the rate is not just as fast, as it normally was. But what do you think is that point where, when we go to the markets and the supermarkets, we can actually feel that, that inflation burden is lessening? When do you think we'll get to feel that in Nigeria?
Well, you should be seeing it in terms of the monthly prices. You should be seeing that they're not going up. The trouble is that retailers will often raise the prices when the currency's weakening, when they see a lot of inflation around them. When the currency starts strengthening a bit, as we've seen since the beginning of the year, they then tend not to cut prices. So they're quicker to raise the prices when things are bad. They tend not to cut the prices too much when things are good. So it's not that you will feel your monthly bill go down, but I think you should feel that your monthly bill is not going up anything like as much as it was.
Right, and definitely you are the time-traveling economist, and I'm sure you're following most of the tension there in the Middle East, and with some proponents expecting some kind of escalation or maybe a de-escalation coming. But what's your crystal ball telling you about the global economy at this point with what we're seeing play out in the Middle East?
Well, my guess is that we're going to see oil prices at $60 to $65 next month. So all of the spike up we're seeing in oil is political risk. It's not about supply. Iran has been exporting more oil since the Israelis began to attack. So we've got plenty of oil. The markets have priced up oil on the fear that either Iran's exports get cut or that somehow the Straits of Hormuz get shut by Iran, which is how Iran makes its money, of course. 35% of its budget comes from oil exports via the Straits of Hormuz. It would be a dangerous thing for their own regime for them to cut oil supplies. So my guess is the Israelis will call a halt to the campaign within a week or two, and the oil price will drop $15. So when I think about Nigeria, for example, in that context, it's been a lovely 1 month boost. It will have been a lovely 1 month boost to oil revenues and the budget. But I'd be surprised if this carries on more than 3 months.
All right, definitely. We'll keep tracking. Hopefully, de-escalation. Definitely, investors would love to see that going forward. But thank you. It was always great having your perspective. That's Charlie Robertson, the time traveling economist. Thank you for coming on today.
Pleasure.